Ladies and gentlemen, thank you for taking the time to be with us today, and welcome to the M&A Masters Program and our second webinar in the program. My name is Nidhi Kilawala, and I am an M&A partner in Khaitan's corporate M&A group. My colleague Surbhi Kejriwal cannot join us today, and I'll be stepping in for her today. I would like to extend a very warm welcome to this webinar to every one of you, whether you are in our audience in India or around the world. The M&A Masters program is designed to provide sophisticated education and discussion on contemporary M&A issues to experienced corporate executives, in-house legal teams, investment banks, intermediaries, and others participating or interested in M&A in India today. Our subject today is unpacking recent M&A deals. On the next slide is the agenda for today's webinar. Next slide, please. In summary, we will have 4 individual case study presentations followed by a Q&A session with audience questions. If you do have questions, please submit them using the facility provided in the webinar portal. If we cannot cover all questions during the webinar, we will respond offline by email after the webinar. Also, please note that a copy of the presentations, summary notes, and a recording of this webinar will be sent to you after the webinar as a matter of course. M&A is an important part of our firm's practice with more than 50 partners dedicated to this area because India is experiencing massive growth in M&A transactions. Every year, we survey our M&A clients and associates in order to understand what they are interested in and how we can serve their interests better through programs like this one, the M&A Masters. One of the most common requests from our clients and associates in these surveys is for more practical case studies on real M&A transactions. You have asked us for examples of real M&A cases and deals and lessons that are to be learned from these transactions. So today's webinar is in response to what you have asked for, namely case studies on recent M&A transactions to explain how those deals were done and lessons that can be borne in mind for future deal making. Our presentations today cover M&A deals in 4 different sectors from manufacturing to hotels, providing coverage across a broad range of industries and diverse transaction types from controlled transactions in a listed company to private M&A. Everyone who has registered for this webinar should have received by email already a summary of the presenters and their credentials to talk today. So I will not spend much time introducing them. Suffice to say that they are all experts in this subject matter and qualified to express their views and opinions on M&A. Our presenters today are Khaitan partners working in the corporate M&A teams of our law firm and are Abhishek Dadu, Sarthak Sareen, Ashray Rao, and Tanvi Kumar. So without further ado, I'd like to start and bring in our first presenter, Abhishek Dadu, who will be presenting on the takeover of TCNS Clothing Company Limited, which is a listed company that designs, manufactures, and sells women's clothing. Over to you, Abhishek.
Thank you, Nidhi, and thank you everyone who's taken the time to join us today. I'm a part of the public M&A practice at Khaitan, and we specialize in listed company transactions. So it's only fitting that the first case study deals with the majority or control acquisition of an Indian listed company. What is really interesting about this case study is the structure that was used in the form of a conditional open offer, which was effectively used to ensure that the acquirer gets to a minimum of 51% in the listed company. What's also interesting is that this structure has only been used once before in India. But as we will see, it's a highly effective structuring tool, and hopefully we'll see a lot more of it going forward. A brief overview of the deal is Aditya Birla Fashion and Retail Limited is the acquirer. They are looking to acquire majority or controlling interest in TCNS Clothing Company Limited, which is a listed company. The sellers in this case are the Pasricha family. They are the promoters of TCNS, holding about a 31% stake. The overall deal value is around 1700 crores, roughly equivalent to 200 million USD. The key elements or the key objective in this deal was for the acquirer to acquire a minimum of 51% in the listed entity. So their objective was to either manage a 51%, thereby consolidating, or they wanted to walk away from the transaction altogether. And that's where a conditional open offer comes in, because it's one of the tools that allows you, as we call it, an all or nothing transaction. So you either get exactly what you want, or you have the freedom to walk away from the whole deal. And we will come to what a conditional open offer is in a minute. The rationale, of course, was to acquire control, consolidate. It's a part of Aditya Birla's strategic acquisition because they are in complementing business spaces. The overall deal timeline was quite efficient. It was completed in 4 months from announcement till completion of the open offer. Next slide, please. So before we get into the structure itself, maybe we'll spend a couple of minutes just understanding what a conditional open offer is. Anyone who's dealt with a listed company knows that if you agree to acquire 25% or more in a listed company, or you intend to acquire control in a listed company, you trigger something called a mandatory tender offer, which is nothing but the acquirer going to the public and telling the public that, look, I'm taking control of this company. If you would like to sell your shares, here is an open offer where you can sell a minimum of 26%. And if they sell those shares, the acquirer is bound to buy those shares, right? So traditionally in an open offer, there is no option that an acquirer has. If the public sells to him, he has to buy it. The only exception to this is in the form of a conditional open offer, where a buyer can agree to buy more than 25%, which is what happened here, trigger an open offer, but in the open offer, set a condition that if I don't get a minimum tendering, then I will not go ahead with acquisition of any shares in the open offer. But at the same time, the acquirer can't acquire any shares in the underlying transaction either. So to take a very simplistic example, let's say a person is looking to buy 30% in a company, triggers an open offer for 26%, and they can put a minimum condition. I need a minimum of 10% or 15% in the open offer. If I don't get that, I will not buy any shares in the open offer. Now, if that threshold is not achieved, not only will they be forced not to buy, or not only do they have to not buy anything in the open offer, but also in the underlying transaction, they won't be buying anything there. So it's their right to walk away from the whole transaction, and therefore the all or nothing reference to this structuring tool. Next slide, please. So with that background, let's come to the case study we have at hand. If you see the slide before you, on the right-hand side, you see the pre-takeover structure. I'll walk you through the holding that was their pre-takeover, which was the promoters held about 31% in TCNS, which is the listco. The acquirer, Aditya Birla, obviously at this stage held no stake, and the public held about 69%. And their objective, the objective of the acquirer was, of course, to acquire 51% and nothing below that. So the manner in which they went about achieving this was they signed a share purchase agreement, and in the share purchase agreement, they agreed to acquire in the range of 22 to 31% from the existing promoters. When they sign this contract of 22 to 31%, they trigger an open offer. And in this case, the open offer was for 29% of the total shares of the company. And with the condition that they must get a minimum tendering of 20% in the open offer. So if they don't get a minimum tendering of 20% in the open offer, the acquirer has the right to walk away from the entire transaction. Now, let's see how these numbers add up, right? Because let's keep in mind the ultimate objective is the 51%. So the buyer is looking to buy between 22 to 31% with an open offer which has to be in the range of 20 to 29%. there are three possible scenarios. One, your tendering is below 20%. If it's below 20%, you have the right to walk away from the entire transaction. If it is, let's assume 20%, in that case, what the acquirer would do is buy the 20% from the public, and it has the ability to buy 31% from the promoters. So the 20 plus 31 takes it to 51%. Similarly, if there is full tendering, that is 100% tendering takes place of 29%, then they get 29% from the public and they buy 22% from the outgoing promoters. 29 plus 22 taking them again to 51%. So that's how the deal was structured to ensure that there is a guaranteed uptake of 51. Anything below that would allow the acquirer the right to walk away from the transaction altogether. And as it happened, there was in fact full tendering in this case. So there was a full 100% tendering that happened, and there was a 29% uptake in favor of the acquirer, resulting in the acquirer buying 29% from the public and 22% from the promoter, taking its holding to 51%, which is what you see as the second post takeover structure on the right of your slide. Now, along with the regulatory aspects on how to structure a conditional open offer, what percentages should go in the primary triggering transaction, what percentage your open offer should be. In addition to the regulatory aspects, another key aspect is the pricing aspect, which of course nobody controls, but there is a certain thought behind how you can try and structure or predict how things might go in the market realm. Next slide, please. So what we've done is for this case, we have run the pricing analysis for the period of the transaction and a few months before. So the deal was signed in early May. And if you see the pricing analysis we've presented starts from March and ends in September, which is when the deal finally concluded. So if you see the period between 1st of March till early May when the deal was announced, the stock price is somewhere in the range of 420 to 480, right? That's where it sort of hovers. And finally, when the deal is announced, at that point in time, the price hits around 520. Now, you will notice that just before announcement, there is a steep up curve on the price, which is very typical of Indian listed company deals, primarily on account of it's possible there was a news leak or something of that sort, and the price tends to sort of move at the last minute. Now, what's very interesting is that the volume weighted average price at the time the deal was announced was 485, but the deal was announced at a price of 503, which is approximately a 20 rupee premium to the volume weighted average price at the time. Now, this is important because what you must keep in mind is in a conditional open offer, your objective is to try and get more tendering. And the only way you can achieve more tendering is if you sweeten the deal and you offer a premium to the public shareholders. Because if you were to do the base case, it is unlikely that you will have a lot of tendering from the public. Now, let's see what happens once the deal is announced. Immediately on announcement of the deal, you see that there is a sharp fall in the market price, right? So it falls from about 520 in a few days to around 400. Now, this could be for a variety of reasons. It can be on account of the market reacting adversely, or the swap ratio, which was in the context of a follow-on merger, not being thought of as beneficial for TCNS as opposed to for Aditya Birla, for whom it would have been beneficial, or general market factors, right? So because of those factors, we see the price has corrected, and then for the rest of the duration, we see the price remains tempered at that 420 to 460 range. Now, what has happened because of the price staying in that range is that the offer price, the open offer price of 503 suddenly becomes a very attractive proposition. And therefore, you see that in the tendering period, which was from the 8th of May till the 23rd of May, the price remains below the open offer price, and therefore you have a high degree of tendering. Now, this is an obvious result because you can effectively buy these shares in the market for 480 or 440 and immediately sell it in the open offer for 503 rupees, right? So it's an instant profit. You will see most cases nobody is really looking to sell these on the market, but only sell it in the open offer. And that is the element of sort of considering the price. Now let's flip the situation. If the price had gone up, in that case, you wouldn't see this high degree of tendering. Next slide, please. So ultimately, what we see is that in this case, there are three key takeaways we have. The first being that it's an all or nothing structure that a conditional open offer offers to anyone who's looking to do an acquisition. What that means is that you can structure a deal, have an end result in mind. If you don't get that end result, you have the ability to walk away entirely from the transaction. It is important to also keep in mind the market price at the time, how the market may perceive it, and the potential premium that you would like to add to the offer. And finally, whenever crafting a public M&A deal, it's important to keep the long-term horizon in mind. Like in this case, there was a merger that was also announced on the same day, which was a long-term strategy, right? So because of various consideration, including insider trading aspects, it is always better to think long-term and maybe make a disclosure at an early stage rather than keep it at a subsequent stage. With that, we come to an end of this presentation. Thank you very much for listening in. We will take questions at the end. And with that, Nidhi, back to you.
Thank you so much for that, Abhishek. It's very interesting case study, and I think I'm going to use this opportunity to now turn this over to Sarthak, who will be presenting on an interesting acquisition in the chip segment, in what was one of the largest deals in India last year in this space. Over to you, Sarthak.
Thank you, Nidhi. And thank you, everyone else, for attending this webinar today. The deal that I'll be talking about is a 100% strategic acquisition by a foreign acquirer of a private company engaged in this transformative sector, semiconductor. So starting with a quick overview of the deal, it was a cross-border private M&A deal where we were acting for the foreign acquirer, a global leader in the semiconductor industry. The target is a technology and a R&D company engaged in designing semiconductor chips, as Nidhi mentioned, extensively IP heavy, and unlike other tech companies of its size, the target was not backed by a financial sponsor, but rather by this group of five individuals who had been developing tech in the semiconductor space for a while and had big pockets to promote the target. The cap table of the target was also quite inclusive, and in addition to the five founders, there were around 12 employees who were on the cap table and holding ESOPs. From a valuation perspective, the deal was, and the target and the tech was valued pretty by the acquirer, a total of USD 300 million. And as Nidhi mentioned, largest deal by value last year in India in the chip design space. Talking about the payment terms, originally an all cash deal split into two elements, upfront payment of 180 million at closing, subject to a holdback, and the balance 120 million structured as an earnout to be paid over a period of 3 years and linked to certain non-monetary thresholds. Talking about the key objectives driving this transaction, from the acquirer's perspective, it was a very well thought through strategic move as the acquirer saw this acquisition as an opportunity to make an India entry and be part of India's semiconductor growth story. Another reason was the potential synergies stemming from the integration of the target's spectacular R&D capabilities backed by an exceptional engineering and design talent pool with the R&D function of the acquirer. In fact, the acquirer saw this potential in the target to transform into the captive R&D headquarters for the group. Lastly, another key factor was the new tech, a new technology that the target was developing, the crown jewel. The target saw this as a game changer when absorbed with this existing tech portfolio, and therefore pegged a considerable premium of 120 million to this new tech. From a timeline perspective, it took us some time, 6 months, and I'll explain why when we come to the structure. Next slide, please. So from a structuring perspective, it was not that complicated. What we had was something very common: a non-resident acquirer, resident sellers, and a private target, right? But what was challenging was the starting point for us. When we were roped in, there was literally one pager term sheet that was guiding us on this transaction, and it just simply had the broad commercials, headline number, the fact that there would be an upfront, earnout, holdback, exclusivity period, and that's about it. So basically, it was an agreement to agree on the commercials itself. So transforming that one pager into a full-fledged deal document was a hard track, as along the way, we had to also firm up the commercials and test them against the regulatory, legal, tax landscape in India. So, of course, there were many issues to discuss. A few from a regulatory perspective. 100% foreign investment is permitted in this sector, including chip design. So our task primarily was to ensure that the implementation of the commercial terms do not trigger any approval requirements. For instance, when we were assessing the choice of entity to make the investment, whether an Indian entity or a foreign entity, since there was a holdback, unlike a foreign acquirer, which has the benefit of doing a holdback maximum of 25% and 18 months from the date of the agreement without RBI approval, this benefit is not available to an Indian foreign owned and controlled company. So for us, the choice was clear. We had to go with a foreign acquirer. Similarly, the transaction, given there was a foreign acquirer, resident seller, had to be reported to the Reserve Bank of India in a prescribed form FCTRS. And the requirement under law is that till the time this form is not approved, the foreign acquirer cannot be recorded as a shareholder in the register of members. So, given that the acquirer had paid the consideration at closing for the 100% of the shares, the task to ensure logistically that we get the acquirer in the cap table and register of members was again something that we had to think through from the very beginning of the transaction. Next slide, please. Other issues, interesting issues that I'll be talking about. Price mechanisms. Price determination goes to the heart of any transaction, and the mechanism applied to establish the purchase price is the key. It's all about the money, right? So there are two common mechanisms, lockbox and completion accounts. The main difference between these two mechanisms is the date on which the risks and rewards pass from the buyer to the seller. The reference date effectively is the date of the underlying accounts and financial statements of the target, which form up the price. In case of a lockbox approach, the price is locked on the signing date itself, and the reference is the last available audited account, so they predate the signing. And absent any leakages or warranty claims, the buyer does not have the opportunity to true up. So effectively, the deal risk passes to the buyer from the date of the reference accounts itself. Now, completion accounts, on the other hand, allows the buyer the opportunity to true up and test the closing price, because the reference accounts are the post-completion accounts as of the completion date. The buyer prepares the completion accounts to test the estimated price paid at closing against the actual financial position of the target at the closing. So in our case, as I mentioned, one pager term sheet, it simply said there's a $300 million number subject to customary adjustments. What that meant was up to negotiation. So of course, from the sell side, the proposal was let's use lockbox because it's more seller friendly. It provides certainty on price. However, the buyer, on the other hand, wanted to use completion accounts since it protects the buyer against value erosion. And but the buyer remained firm, and there were two reasons for this. One, in our deal, it was a staggered sign and close. So there was a time lag between signing and closing, and this was primarily due to the fact that the company was IP heavy. The buyer was doing an IP diligence. It took time to test the technology. And so the buyer's main focus was that if you lock the price at signing, then the sellers would not have incentive to focus on the existing business, grow it during the interim period, but rather focus their attention on the new tech to secure the earnout, right? So that was the main concern. The other one being that there's a new tech in development, and how much cash it guzzles, the working capital needs of the company is volatile. So the buyer maintained the position that a lockbox does not work, and to break that impasse, we had to effectively explain to the sellers, convince them that what's the upside, right? The benefit of using the completion accounts was the fact that during the interim period, the sellers would continue growing the business, and then ultimately they'll reap the benefits of the ultimate price at closing. That helped, and ultimately we were able to close completion accounts as the approach. Next slide, please. The other interesting issue on the transaction was earnouts. As I mentioned, that there was a significant earnout piece. And what are earnouts? Earnouts are contingent payments based on satisfaction of future performance or achievement of certain predefined milestones. These milestones can be monetary, such as revenue targets, sales targets, or non-monetary, such as development of a product or tech, which was the case in our deal. Earnouts are very common in IT and tech deals, and it's a classic transaction tool that helps a buyer mitigate the risk of overvaluing or overpaying for a target or a business. And at the same time, from a seller's perspective, it works as an incentive to unlock unrealized value and to take home a fatter check. So in our case, what our deliverable was as a deal counsel to form up a structure, that earnout structure that works from an India law perspective. There were many options that we considered. Some of the common structures you can see on the slide. But the common one is a deferred consideration where the buyer pays for the 100%, acquires 100% of the shares at closing and pays partially for that. So in our case, out of 300, 180 was supposed to be paid at closing, 120 to be deferred. But given there is a regulatory cap of 25% and 18 months, clearly it didn't work in our case because the amount we were deferring was 40% and for 3 years. So this option didn't work. The proposal from the sell side was to use something called leaving a stub. Effectively, what that means is that the buyer would acquire a majority stake in the company, but the sellers would hold on to a minority block. Their proposal was 74% for the buyer to acquire and 26% for the sellers to hold on to, and link the earnout to the minority block, right? However, that clearly didn't work for us, for the acquirer, because from day one, the expectation was it's all or nothing. We want the company complete control. So the counter proposal that the sell side had was to use something, a different capital instrument, which does not dilute the equity cap table or the rights of ownership. So they proposed compulsory convertible preference shares. Again, could have worked, but in an earnout, the risk we ran of this option was the fact that in a worst case scenario, if the technology fails and the earnout is nil, right? The buyer being a foreign acquirer and the sellers being resident sellers, the buyer would still need to pay fair market value. That's the minimum floor price you have to pay under law for this instrument. So that's something that's a risk the buyer was not willing to take, and it doesn't work aligned with the commercials of an earnout. So again, this option was shut down. The option that we had formed out from the buy side perspective and presented was delinking the earnout completely from the cap table and linking it to the employment of the sellers. The fact that the sellers were continuing in employment because they had to work on the tech and the new tech, and it was simplest choice, and it worked because they're not on the cap table, but they still are incentivized to continue developing the tech and take home a fatter check if the tech works. So that was our proposal. But from the sell side perspective, the downside was that this was highly tax inefficient because linking anything to the payroll employment is a perquisite. It's taxed at the highest tax rate under Indian tax laws. So there was a lot of convincing that we had to do, but there was commercial substance in the structure. So we had to somehow convince the buyer to meet this at a halfway, gross up partially for the tax. So the buyer did that. The buyer offered something as a phantom stock. That was compensation at the buy side level, at the issuing entity level, where the economic, which instrument, which effectively confers economic benefits of the buyer's stock to the holders without actually giving the ownership of the shares. So effectively, it's the economic benefit that passes of the price movement. Now, so the buyer was willing to meet the seller halfway. From the sell side perspective, we told them that, look, it's not possible to get a bigger piece of the pie. Nothing is working. So this alternative option is increasing the size of the pie. They understood the merit, and effectively parties shook hands on earnouts in linking it to the employment. Now, coming to some deal learnings from the transaction. Next slide, please. So the key learning for us here was that risk allocation between the parties has always been the most critical, significant aspect of any M&A deal. And tools like lockbox, completion accounts, holdbacks, earnouts, escrows, they're common tools to facilitate such risk allocation. However, every deal has its own unique set of specifications, circumstances. There's no one size fit all approach. So it needs to be determined on a case to case basis what tool or what risk allocation methodology or mechanism will work in your case, right? And in case there are some tools that you are using in your deal, in a transaction for risk allocation, what's important is that the way it's drafted and constructed, it should be watertight so that you mitigate the risk of any disputes or interpretational issues post closing. Another important learning, transaction structures should always be backed by commercial reasons and not alone by tax factors. We clearly saw in this deal that linking earnout to employment was highly tax inefficient, but it was commercially sound because nothing else was working. And once we made the party see the potential, it worked. Lastly, appropriate and timely legal and tax advice is a must. We were involved later once the term sheet was signed. I always tell my clients, let's involve us from the very outset so that at least we can flag what are the concerns that you should be aware of when you're doing the deal. With that, I conclude my presentation. Thank you all for listening in. Over to you, Nidhi. Thank you.
Thank you so much for that, Sarthak. I think the key and most interesting message to me was that deal making is in equal parts an art and a science, and as M&A lawyers, having visibility and understanding of the commercial considerations and goals of the parties while entering into an M&A deal is key to successfully representing your client's best interests and effectively navigating both parties to the deal to a win-win situation. So thank you so much for that, Sarthak. I'm now going to move to the media and entertainment sector, where Ashray will help present on one of the top 10 M&A deals in 2023, which helped to shape the media and entertainment industry. Over to you, Ashray.
Thank you very much, Nidhi. Hi, everyone. I'm a partner with the corporate M&A practice at the Mumbai office of Khaitan. In the last year or so, I've had a chance to work with a lot of control transactions, and today I'll be presenting on an interesting case study involving acquisition or a controlling stake in a startup and its associated challenges. So today the presentation is split into largely three, four portions. The first one being largely just to give an overview of the deal rationale. After that, we'll go into some of the key challenges faced from a commercial and from a legal perspective. And then we'll sum it up with some of the key takeaways for any transaction involving acquisition of controlling stake in a startup entity. Uh, Now, we were representing the acquirer on this deal, who is one of the larger and older players in the media and entertainment segment. As you are aware, this industry specifically has gone through a lot of changes, and that's something every player in the industry is trying to grapple with. Are they ready for the future? So one of the new age segments is something which caught up their interest. So they started exploring this target company which was engaged in a new age segment or a subsector of what the client was doing. And as a background, they had some very solid promoters, three, four individuals who had been with the company for a decade plus. They were also backed by some of the marquee venture capital funds in the country. And the product was also amongst they had some very good products which were sold to various production houses and had done fairly successfully well in the last few years as such. So as such, the rationale was very clear from the client where they wanted to pivot into a new segment and find an asset which was, they could consolidate make it a strategic fit into their larger group ambitions. But one thing which was very clear upfront was they were not comfortable in doing this deal unless they were okay to acquire a control and subsequently they could consolidate the entity into their books. Uh, so Largely, from a timeline perspective, I think the why I'm talking about the timeline is because I think that's when you need to see the number of challenges which was faced by both the acquirers and the sellers in this entire deal. It took about 6 months from the time we executed the term sheet, uh, and I think we'll see going forward why it took such a long time. Next slide, please. While the challenges were multifold, what I tried to do is briefly summarize the challenges into, I think, two slides today. I think the first and foremost challenge was, which can be in any kind of acquisition of a startup entity, would be most startups end up raising funds from multiple shareholders. And over a period of time, if you're looking at a fairly mature startup entity for acquisition purpose, will have various stakeholders. They'll have multiple securities, and these securities could be anything from base equity into any kind of a convertible and various classes of equity or various classes of these convertible equity or preference shares. So that itself and understanding the nature of instrument issued till date becomes a bit of a challenge. And because of the number of parties involved, which comes to the second issue on the right, which was finding a cohesion on some of the commercials, becomes very, very important. And when you say commercials, it could be anything from the extent of risk management or the extent of payment structure or the mechanism or who will exit, not exit, becomes a bit of a challenge in some of these situations. Another unique situation, or I guess it's fairly common now in some of the startups which have raised funds from multiple investors, is also the fact that the stake held by the promoters tends to be either in single digits or in the lower double digits, which then raises some of the questions again on the right side, which is if we need to do this acquisition, who will manage or backstop the risk. So any M&A deal involves a fair bit of risk assessment between the parties as to who will bear the risk for some of the actions in the past. And then you start categorizing them into various kinds of warranties and eventually come up to some kind of an indemnity protection. But in a situation where a startup is substantially held by venture capital funds who would not be engaged in the day-to-day operation, and the promoter stake is kind of in the very low numbers, what kind of protection is the best way forward becomes a question mark in a deal of this nature. Uh, Another unique thing which could happen in most of these startups was, I think, while the negotiations on broad term sheet was executed, they were not okay to offer full exclusivity on the discussions because, especially if you see the current environment and where the startups are today, fundraising has not been the best compared to a year or two back. So they would keep looking out to raise funds in the interim, or the worst case situation that any of the M&A deals which they are exploring doesn't go through. So in our case too, they were exploring, and in fact, they did bring in a new investor during the negotiations of the entire transaction. That adds a bit of additional complexity into the entire decision making, the dynamics of the party, the rights, the exit, etc., which was provided for. Another important factor is also, I think, from a commercial perspective, every sector has a unique way of determining the valuation. And in the particular segment we were working with, and especially in the media segment, it's fairly common for a production house, for example, if they engage you into a particular project, to pay you a certain advance. Now, that is considered as revenue in the books, but nevertheless, there is a possibility that if the product is not accepted in the end, there is a full-fledged refund mechanism which is executed by parties contractually. Now, in this kind of situation, how do you allocate revenue as of the closing date, or any kind of valuation linked to some of these methodologies becomes a bit of a challenge. Uh, okay, we'll go to the next slide. So basically what we spoke about with respect to the nature of the instruments and the various kind of convertible securities, etc. One important factor, like I mentioned earlier, one of the deal rationale or one of the main requirements was to acquire, control, and consolidate. Now there were two options. One, you require some of the convertibles to be converted into pure equity at the time of acquisition, uh, but that has its own challenges from a legal and tax perspective. Or the second option was just acquire securities of up to 51% on a fully diluted basis. Now, determining the fully diluted basis also was a challenge because while a lot of drafting is involved and many lawyers involved in the startup space put together their minds to ensure that a fair way of deciding sorry, the FDP calculation is provided for clearly, it does tend to happen that eventually there is a bit of ambiguity. There is no 100% guarantee that this number will lead to X number of shares or resulting in X percentage of control in the entity. Uh, Another important factor here also would be also to ensure this control, other than the factor that you may acquire up to 51% stake in the company, uh, also the relevant documentation had to really capture that we will have a controlling stake in the document going forward. Uh, Now, another unique provision which is also here, and this again linking to the number of sellers and the buyers which are involved. So, whatever the parties may kind of craft together as a commercial understanding, you need to be very careful about the extent of the regulatory restrictions applicable on each of the buyer and the seller in the individual capacity. So, understanding the taxation status and the FEMA residency status of each of the sellers becomes very important. Uh, so, to understand whether person is subject to certain grandfathering provisions, which should we withhold, which we not withhold, should we have certain adequate protection or indemnity for the risk assessment, and which person is a resident, which person continues to be a resident for tax purpose, but is not a resident for FEMA purpose, etc. This determination was a bit challenging because of the sheer number of shareholders who were involved and the kind of unique situation each of them were particularly involved in. And lastly, I think, like I mentioned, this 51% uh, was important, and any kind of default they really wanted to adequately protect for, because that was either you do a 51 or you walk away from the deal. So let's go into the next slide and how the commercial and legal team involved in the transaction kind of solved for some of the issues which were put forward. So let me first touch upon the acquisition structure. What we did to achieve this 51% was undertake a combination of a primary and a secondary acquisition, where in the event of a certain shortfall, either due to a default of one of the individual sellers or any of the identified sellers, the acquirer had the opportunity to invest the stub amount uh, to reach 51%. Now, if the default was substantially more than what the purchaser was willing to commit at the relevant point in time, they kind of then identified few promoters who would then sell their stake to ensure that at least this 51% was achieved. Also, in a transaction of this nature, it's important to then really set out that what is your pathway. So there were multiple provisions in the documentation where, other than the first tranche, you also then have a clear pathway to 90%, because as corollary to the discussion, the funds were not. The funds are very clear that I think after they sell half of their stake, they were wanting a clear pathway to exit. However, they took the punt on not agreeing for a fixed amount, but actually putting together the similar kind of valuation which was set together now. The formula which was implemented at the first tranche was to be implemented in the second tranche. So coming to that, was the second question on the valuation. The valuation was decided based on somewhat of a multiple which is applicable for the sector on LTM revenue basis, and LTM is largely considered the last 12-month revenue. Now, this ensures that even though the timeline of the deal went from, 1 month, 2 months, to ultimately 6 months from the date of the execution date, the company's continued interest in ensuring that the revenue is generated so that the valuation multiple is held and they get good value for the amount which were negotiated with the buyer. Um, like Sarthak mentioned, there's a typical completion date accounts judgment methodology among the two options. They chose this one. So robust provisions in relation to the EV to the equity bridge through net working capital and net debt adjustments was undertaken. Uh, and also, I think it's important that when there are so many parties involved, you need to have a very clear mechanism on which is the party which will decide on the basically the determining the working capital, the deciding the net debt element, and also deciding what would be the computation of the particular formula. to come to the consideration. So instead of having so many players involved, you have identified one representative from the investors and one from the promoters, along with the purchasers, who can kind of decide on all of this, and everybody is just bound by this entire process to just make it more efficient. Coming to the earlier question we had on who will backstop, considering the, I think in this particular case, the asset was very, very good. So the acquirer did take some practical calls in deciding that fair enough, they will go down the route of getting probably a lower percentage of protection as maybe usually negotiated by them in the past. But I think the robustness of the DD, along with the fact that they were backed by a lot of these marquee investors, gave them a bit of the comfort that it's fine. Largely, the responsibility or indemnity was split across all the sellers with very, very reasonable limitations of liability. Uh, and this is something we'll again do as one of the key takeaways. But negotiating the package for the promoters became very, very key. And this is one of the key takeaways from this entire process is when dealing with any kind of startup. I think the approach of the acquirer vis-a-vis the promoter becomes one of the very important factors. I think the approach should be in a way to consider them as a partner and not look at them as any other capacity. They should do that, and then the rights which are being offered to the promoters, etc., may not be comparable to those percentage of stake which they're currently holding, but more of what value they can deliver in the future years going forward if they're continuing in the relevant business. And other typical provisions which you would expect from any kind of an arrangement with the promoters, where there is a dual capacity going forward. One is their managerial capacity and employment with the company, and second is their minority shareholder status in the company till they have somewhat of a pre-agreed plan. We have seen those issues happen with certain promoters, and there is either a misalignment due to committee finding or misalignment due to some commercial interest between the shareholders and the promoters completely being bad path going forward. So typically in agreements, we also execute somewhat of a pre-agreed exit path, playing out various scenarios. Think about it as a good lever, it's a bad lever. You've got somewhat of a liquidity event and somewhat of a protection, also to factor in the internal restructurings of the acquirer and the group as a whole. So largely, I think the to sum it up, I think the balancing the individual versus group rights becomes very, very important, and not every startup transaction will have the same kind of problems. Not every seller has the same kind of problems, but dealing with it in a practical way, I think, will be the way forward if the asset is hot and is something which everybody should is interested. Let's move to the last slide. Yeah, but talking about the key takeaways, I think one we already discussed about taking the partner approach, and I think this was very, very important. I think a lot of heavy lifting was undertaken by the promoters, where they were the ones negotiating the positions and then kind of convincing a lot of these investors and the other individual sellers at the back end. And I'm sure this entire upside sharing and incentive, some of it which Sarthak already covered, uh, any kind of methodology can be used, whatever fits the purpose at that particular time for the transaction. But I think dovetailing that into a robust corporate governance framework becomes very, very important, considering that it's important that largely that there are the checks and balances on their rights and the approach which the promoters have vis-a-vis their own company. Some of it on the indemnity and the protection packages. I think every sector we need to look at it very differently, depending on the diligence, etc. One option could be definitely to check, whether a WNI insurance can be obtained for something like this. But in the current situation, they did explore this, but they didn't go ahead. But that's a good solution for something going forward if you're in a similar fact pattern and there is no real entity which could backstop any of the warranty obligations of the party. And I think the last, which is similar to what my other speakers have mentioned, I think any kind of commercial provision, whatever is kind of explained to the client, explained by the client to the legal counsel, uh, we need to definitely highlight it upfront, whether it's doable, not doable, and if it's doable, at least ensure that it fits within the particular regulatory framework. So we had a lot of smaller provisions here, like there was a holdback, there was a trans acquisition, there was an option. All of these were drafted in some manner that at least going forward, there is no challenge from an enforceability perspective. Um, so that's about my key takeaways from this, and hope you found it interesting. Any questions? Happy to take it up at the end. And over to you, Nidhi.
Thank you, Ashraf, for that. I think it's becoming increasingly common to talk about the manner in which the cap table has been stacked up with digital advancements. What we're seeing in a lot of the new and emerging companies is access to these cap tables being opened up to a wider audience. And that's resulting in the natural and the next logical question, which is investors spending more time on checking the health of these cap tables and whether fragmented cap tables and consolidation of these cap tables is at all possible when you're looking at control deals of the kind that you just mentioned. So thank you so much for drawing our audience's attention to that case study, Ashray. Finally, I'd like to bring in Tanvi into this conversation. Thanks for your patience, Tanvi. Tanvi will now present on the acquisition of Duet Hotels by Samhi, which is India's largest pure play asset owner of branded hotels. Over to you, Tanvi.
Thank you, Nidhi. And I once again welcome the audience to today's session. I hope you're finding it insightful. I'm part of the corporate M&A practice and I specialize in complex private M&A transactions in diverse sectors. So after the interesting case studies pertaining to public market situations, deferred consideration models, control transactions, I will now discuss an interesting M&A situation involving Sami Hotels, which implemented a pre-IPO acquisition of Duet Hotels to enhance IPO value by way of an equity swap transaction. There have been very limited situations involving a significant M&A transaction being implemented while a company is in an IPO mode, and this is one such successful example of such a situation. So as the way that I'll run the session is that I'll start with going through the factual matrix, which you will see on your screen now, and discuss some interesting deal issues involved in the transaction. So the parties to the deal were Sami Hotels, a prominent branded hotel ownership and asset management platform in India, with a portfolio of 25 operating hotels as of last year, which is when the deal was signed and closed. And we had Asiya Capital Kuwait, which held 9 SPVs in India, operating 6 hotels through Mauritius holding companies. The deal involved 100% stake sale in each of the Dual Group entities from the Mauritian holding companies to SAMI in consideration for 30% shares of SAMI issued to it by way of the swap. Next slide, please. The peculiar circumstance of this deal was that the company was preparing for an IPO while the term sheet was signed. The company had received SEBI's final observations for its IPO previously, but had to defer its plan due to COVID-19 a couple of years before this deal was stitched. The transferor was looking at exiting the Indian portfolio. Assets of the transferor were complementary to those of the issuer company and would add material scale and operational synergy to the issuer company's existing platform. The issuer company therefore issued equity shares to the Mauritian holding companies, constituting 30.51% of its pre-offer fully diluted cap table. These equity shares were issued by the issuer company by private placement as consideration for the securities acquired by it of the 9 SPVs held by the Mauritian entity. Since this was achieved by way of a swap transaction for determining the swap ratio, the subscription and the shareholders' agreement recorded a reference enterprise value of the target group SPVs and as well as the issuer company, thus arriving at an effective equity value per equity share based on the pre-money value of the issuer company. Based on the equity value of the SPVs, the resulting number of shares of the issuer company were agreed to be issued to the transferor entities. Of course, there were also complex formulae and mechanisms to equalize differentials in relation to working capital adjustments and net debt adjustments, but I'm not going into that complication for the purposes of this presentation. May we move to the next slide? This slide shows the post-closing group structure, wherein post the swap transaction, the issuer has its own portfolio of 27 hotels held through its subsidiaries and 6 SPVs that it acquired pursuant to the transaction. The Mauritian funds became direct shareholders by way of swap of the issuer company. The shareholding that you see here is the post-listing shareholding. Of course, there was further dilution between the time that the deal closed and, the listing on account of conversion of other securities held by certain other shareholders. Uh, Next slide, please. So as I mentioned, the deal was IPO driven and would be successful with a successful IPO. Combined entity would mean deleveraged debt ratio for SAMI on a consolidated basis, a better valuation for SAMI in the IPO on the basis of its consolidated financials, exit for the transferor from its existing India business, ASEA getting participation in listed securities, the resulting entity post-transaction being a significant player in the market with increased market share. So overall, the deal would be a win-win situation for both the sides, provided the IPO happens. And therefore, there were certain challenges, which we will now come to. Next slide, please. So the first key deal issue was the IPO uncertainty and the timing of the closing. Since cap structure is required to be frozen prior to the red herring prospectus, the deal was envisaged to close prior to that. Since the IPO was the main deal driver for both the parties, as commercial objectives could be only be achieved with the successful IPOs. Therefore, the one key issue that amplified was what happens if IPO is not successful by a specified long stop. Now, to mitigate this risk, the transferor's preferred position was to push for the closing to be undertaken prior to the filing of the red herring prospectus, as by then the SEBI has looked at the offer document, has commented, its comments are addressed, and then there are lesser contingencies of the issuer not proceeding with the listing. Issuer was guided by its merchant banker, was keen to close prior to filing of the updated red herring prospectus, which was more consistent with the market norm of having a crystallized cap table prior to filing of the UDRHP and demonstrating a fully baked cap structure to SEBI. The second issue was pertaining to fall-away of rights. Now, SEBI requires all special rights associated with any securities issued by an issuer company to be terminated and all convertibles converted to a fully diluted cap table prior to filing of the red herring prospectus. In order to avoid SEBI questions and its market practice, merchant bankers usually require all such special rights suspended prior to filing of the draft red herring prospectus. The parties to the deal were aligned to get into the transaction only if the company successfully lists, failing which both parties wanted to achieve status quo. Now, this meant that there needed to be some understanding for interim minority protection rights to be available to the transferor after the long stop date if the issuer does not list. The cap table of the issuer company itself had various institutional investors with different securities, different rights associated with such securities, and the governance regime was also agreed with a myriad of operating shareholder rights for its existing shareholders. Such investors also had mechanisms to have their existing shareholder rights reinstated if the IPO does not happen. To negotiate, therefore, a rights package in such a situation, that too with a view to ultimately unwind for the transferor in a situation that IPO does not happen and there is this reinstatement of rights for everyone, was challenging. The transferor's position was, of course, to have a clear understanding about its minority protection rights if such rights of the existing shareholders are reinstated in absence of a listing scenario. The third key issue was minimum IPO conditions. The company had been preparing for an IPO for several months before the parties signed the term sheet. The IPO process was being driven by the merchant bankers. However, the commercial rationale of the deal was to achieve a particular valuation and post-listing interest for the transferor and to ensure that the IPO succeeds. In this context, the transferor sought that the acquirer or the selling shareholder in the IPO shall not withdraw from the IPO, shall not change the agreed price band, shall not change the IPO size without seeking its consent. This was, of course, pushed back by the issuer's merchant banker in order to have no conditionalities associated with with its own IPO process. The next issue was the concept of an unconditional closing. Now, the issuer's position, as advised by its merchant banker, was to have unconditional closing under the transaction document, timed 1 day before filing the updated DRHP after the board approves it. This was again challenging from a typical M&A perspective to for a transferor to get past, and essentially considering always a preference to have some walkaway right for extreme situations such as occurrence of an MAE or a legal impediment to closing. The parties, on one hand, were Mauritian holding companies, which were transferors. On the other hand, it was the issuer company held by the promoter. The promoter held minority interest, and the remaining shareholders comprised of financial sponsors. Therefore, from both sides, there were concerns on having entity of substance to have an effective recourse package, very similar to the issue that Ashray also mentioned in his case study. The next issue was to have, while the initial understanding between parties was to have symmetry in indemnity triggers and limitations, as the deemed consideration for the transaction would have been the same for both the parties, being the value of the shares swapped. But there was asymmetry in how the parties perceived their risk on account of the issuer company being the continuing entity and the impact of breach of the transferor's portfolio on the continuing business of the issuer. The last issue that I'd touch upon would be the reverse swap, which is what happens if the IPO doesn't happen. Now, while issuance of shares by an Indian company to non-residents for shares transferred by it is contemplated under the NDI rules, the reverse situation or the reverse swap constituting transfer of shares by an Indian company of an Indian company in consideration for acquisition of shares of another Indian company from a non-resident is not permitted. Therefore, unwinding the transaction had challenges both from a regulatory as well as a tax perspective. So while there was an existing difference in opinion, the crux of the issue was to provide the transferor comfort on there being minimum contingencies on the IPO. And therefore, to address this, it was agreed that the transferor will be provided with written confirmation stating agreed demand for the IPO. The transferor will have the right to appoint an observer on the board and the IPO committee post closing until the time the listing happens. The transferor will have information rights in relation to the IPO. The closing will only happen prior to the filing of the UDRHP, but approved by the transferor after having complete comfort around the process. So, other than firm IPO conditions, closing was made unconditional on the basis that if an adverse action occurs after filing of the DRHP, such circumstance will also trigger disclosure requirements as far as the offer document go, may have adverse implications on the market uptake and sentiments, and therefore, prudently, the company would anyway suffer and not file for an updated UDRHP to go into that that forbidden territory of having to do an unwinding. There was also principal level understanding on basic shareholder rights that would be available to the transferor if listing does not occur. Now, we did not find a definite path to the unwinding, but this principal understanding definitely added to the comfort of the transferor. On recourse, no fund guarantees were agreed, but scope was left for parties to seek coverage under WNI policies. So, of course, ultimately these gaps were bridged and commercial objectives of the parties were achieved by a successful IPO. Next slide, please. I think how the gap was bridged, what worked for both the parties was an approach to understand each other's pain points and finding an effective commercial solution. Parties showed flexibility as there was utmost commercial alignment. Comfort on IPO demand was provided by the issuer's merchant banker. Transferor was provided participation in IPO process. Due to the extent of the business, the diligence findings which were addressed prior to signing in order to satisfy the IPO requirement of having minimum conditions to the closing. Both parties put humongous amount of effort to address each of the operational issues such as third-party consent requirements, remediation of land title issues, regulatory CPs, etc., which actually had an upside to sort of have a better IPO document as well as all these issues got resolved. And the parties collaborated for implementing a transition plan. So a deal, I would say, very commercially driven, not the usual M&A issues, but great outcome for both parties, enabling unlocking of value of the resultant entity for both stakeholders. I hope you found this case study interesting. Happy to address any questions, and thank you for listening. Over to you, Nidhi.
Thank you, Tanvi, for a very interesting presentation. I hope our audience enjoyed each of those excellent presentations as much as I did. I thought they were very thought provoking. Now, I would like to take some questions from our audience. We've been receiving some of these questions on our chat box. The first one is for you, Sarthak. The question is around acquisition of an unstable target. Among other things, we were looking, and I'm just reading the question out loud, we were looking at the valuation of a prospective target while proposing a lockbox mechanism to the other party. Do we typically assume the risk that the company is as it is represented to be in the financial statements at the lockbox date?
That's right. In a lockbox approach, as I mentioned, you're locking the price based on the last available financial statement. So as a buyer, you assume the risk. But how you resolve and address that risk is, which is common in either format, is you will have customary representations in your document, which will be backed by an indemnity obligation. And as part of the representation package, you would have clear representations on your financial position of the target, the statements, as well as the manner in which the statements have been prepared, and the representations which have been made in the statements. So, yes, you would have to take that risk, but you counterbalance that risk with the form of an indemnity from the sell side.
Super. Thanks for that, Sarthak. The next question we have is on the minimum tendering. So, Abhishek, I think it'll be great to get your thoughts on that. If the minimum tendering does not occur, can the acquirer still choose to buy the shares?
The answer is yes. So the minimum tendering affords an opportunity to the acquirer to walk away. But if the acquirer does not intend to walk away, they have the freedom to still acquire whatever number of shares were tendered. In fact, there is an additional sweetener here. You can actually quote a lower price. Now, if you remember, the whole point of a conditional offer was to try and offer a premium so that you get more tendering. If you don't get that, you can actually, in your offer document, say that I will buy provided the price at which I'll buy it is lower. Now, all of this has to be above the regulatory minimum, but yes, you can still go ahead with the transaction if you so please.
Thank you for that, Abhishek. I think the next question is on risk allocation and indemnity packages. And Asha, I'll request you to help us answer this one. On the representation and warranty and indemnity package, what should be the expectations when acquiring a stake from a VC majority owned entity?
Thanks, Nidhi. It's very tricky, actually. I think obviously the starting position can be that you can ask for, the entire company or the largest shareholder, plus, at least entities constituting 50% of the shareholding to backstop some of the obligations. We found it very, very hard in the past. I think the case study which I mentioned was from the very few examples where people are okay to backstop. While I think one argument you can definitely offer is if they have a substantial stake, for example, like 30-40%, uh, while they may have all the information with respect to the company, are they really in control? Are they not in control becomes a big challenge. Can you treat them as a promoter or not becomes a challenge. So if the VC is majority owned because it's a controlled kind of transaction and a buyout transaction where they're running the business or doing the business, then I think it's a very good position where we should definitely ask for it. But if it's in a situation where promoters continue to run and the obligations of the VC are either we just more investment partners and financial investors, it may be difficult. An approach could be that in this kind of situation, if the stake is very, very low, we've seen that parties are more comfortable taking the approach or taking a WNI insurance policy. It's a good product, and where if the commercials work out with minimal exceptions, I think that's definitely something more and more investors and acquirers in this kind of situation are exploring. So that's a way forward, I would say.
Thank you for that, Asha. I think the next question almost seems like our audience knew the answer to what you were going to say. It's a great segue and good timing to pick up this question. Maybe Tanvi, it'll be great to get your thoughts on this one. If counterparties are not entities of substance or funds that are approaching the end of their fund life, what are some risk mitigation strategies for having an effective indemnity recourse?
In common issues across the board here. Just to answer the questions, I think there are several mechanisms. Um, we've seen solutions such as having if it's a fund counterparty to have fund level equity commitment letters, have restricting some bit of distribution, although you'll have a big pushback if it's a financial sponsor seller. Escrows, we also frequently see the use of WNI in such a situation. So of course, the deal size has to justify the premium. It's also a function on the comfort around the diligence, as well as, of course, the bargaining power of the parties. But I think those are some of the modes to sort of get an effective recourse.
Thanks for that, Tanvi. Our next question is on earnouts. And Sarthak, I'd like to bring you into the conversation here. In an earnout, one of the key elements for the seller is to have some degree of control and visibility on achievement of milestones. So, in the context of an employment linked earnout in the deal that you spoke of, Sarthak, what was the degree and nature of control that the sellers had on achievement of milestones? And is that essential in your view?
That's a good question. And let me start with the last part. It's definitely essential. And in our deal, typically in an earnout, as you correctly mentioned, and in that question, that the degree of control is required, because even from the sell side perspective, the buyer is the one who's taking charge of preparing the post closing accounts. So every seller would expect certain degree of control, and typically it's through staying on the cap table on the board. You have visibility, but if you're not on the cap table and not on the board but just a mere employee working on that particular milestones for the earnout, then how do you take care and show that you have visibility on what's happening? So in our case, this was indeed a concern. And when we were discussing this construct, the way we tried to resolve it for the parties was that we made sure that during the interim period, when we are in the process of closing the other conditions, the parties would agree on a business plan which would squarely cover what are these milestones. It was a very labored effort from a commercial perspective. Clearly lay down the objectives, clearly lay down the KPIs. KPIs also form part, as I mentioned, of the employment contracts of the sellers. All these folks continued, all these folks had the earnout benefit. And so, what was the role of each seller in achieving a milestone was clearly spelled out. And what the board, which was controlled by the buyer, cannot do was also clearly spelled out in the business plan. So effectively, any deviations clearly give the seller the right to contest that there's a breach, right? There's a breach of contract. That's why I was not able to achieve that particular milestone. And so the intent here was, like in any other construct, to have a watertight provision drafted to ensure that the parties have something to abide by, something to be guided by in achievement of the milestones. And in our case, to conclude, the way we did that was we had a watertight water business plan prior to closing, which was effective as of the closing date. And the employment agreements again became key because that's where we had the KPIs, the milestones, all deliverables, responsibilities, including the consequences of an event of default on part of a certain employee. All of that was built in there. Parties were satisfied that this is the way to go. It's still, we closed last year. It's still to be tested. Hopefully everything is good as of date, and fingers crossed. But that's how we managed to control the whole process, for even for the sell side.
Thanks for that, Sarthak. Sounds like two sides of the same coin, and frankly, having just an earnout is not the most helpful unless you also have some visibility and path to be able to achieve those milestones. So thanks for
Absolutely.
that response. The next one we have is on your presentation, Abhishek. Interesting question. You mentioned that this is a structure that hasn't been used in the past. So why isn't it used more regularly as a structuring tool? And like, do you suppose that there was any particular innovative facet of this transaction where it was deployed for the first time?
Yeah. So on the first part, why it's not been used, it beats me. I think it's a great structuring tool. It's something we've often explored in transactions, but I think from a more realistic, practical perspective, there is the risk of a lot of lost cost. If you were to abandon the transaction altogether, you spent a lot of time, money, effort in stitching it together. So just the thought of walking away from it altogether, it is not something that goes down perhaps in a lot of segments. Also from a seller perspective, while it's great for the buyer, I mean, you get exactly what you want or you walk away. We also have to acknowledge this from a seller perspective. The seller runs a much higher degree of risk because they don't know for sure whether they are going to receive an exit, whether the deal is going to close or not. So I think those are some of the key factors. But having said that, over the last few months, we have seen this particular structure come up more and more. Our expectation is that we will certainly see conditional open offers being used a lot more in the coming few years.
Got it. Thanks for that, Abhishek. I think the next question is an interesting one because it brings out a point that's very close to my heart that we do a lot of lawyering, but we also do a lot of deal making, and it's almost like that there are blurred lines between the two now. And this question actually goes to the root of that, which is how do you make the process efficient when a transaction involves varied sellers and their expectations when you're trying to stitch up one common deal? So, would you suggest separate negotiations with each seller, or should this be a common platform to be able to get a good outcome for both sides? If I could request you, Ashray, to give us your views on that, please. I think you're on mute, Ashray. Sorry.
Hi, thanks, Nidhi. Very, very interesting question, actually, because again, it depends on kind of the transaction, and at least I think what helped in the approach is from the counterparty side, we should limit the entire negotiations to one or two people who are responsible for it and kind of help them take that burden to move forward, except for certain specifics. So, in come back to the example of the transaction we worked on. If it's something to do with tax, I think maybe an investment banker who's leading the entire transaction from their side. If not, then definitely I think the entity should appoint a investment banker who can probably do this job of, I think, coordinating between so many sellers and all their demand. And I think we've had so many meetings where we had Excel sheets set out like A wants B, then, sorry, A wants one and B two, C three, D four, and 15 sellers and 15 demand. And then ultimately, I think what really helped was, I think, getting a promoter and the key decision makers, like one or two funds on your side, and thereafter kind of just ensuring that all of the rest of the sellers are aligned and they are just given an option. Guys, we've negotiated this, do it or not do it. This is a good opportunity to exit. So let's just keep moving things forward. But yeah, I think two three things are important. I feel for sure. I think appointing a banker, and I think that partner approach helps in keeping people on your side. So your package, your incentives to the promoters, and how you deal with them may help in swinging the deal. Do it. Separate negotiations are important for certain specific items, I would say, because either for confidentiality or for even a risk assessment perspective, if you need to deal with certain specific sellers if they're being very painful, I think that approach is okay. But largely, I think we should have a single point of contact. Last, thank you.
Thank you for that. I think I'm just conscious of time, so I think we'll take the last question for the time being and respond to the others offline. My last question is to you, Tanvi. In your deal, were there any concerns on the transferor entity being categorized as a promoter for the purposes of the IPO?
In this deal, the issuer company, as I mentioned, was already in IPO when the term sheet was signed between the parties. In fact, this issuer company had previously filed an offer document a couple of years back, wherein it had demonstrated and disclosed itself to be a professionally managed company. And that is the same stand that it continued with for the purposes of the current process as well. So in that sense, while there were lesser concerns around promoter-related liability as far as the offer document go, but nevertheless, as I mentioned in my presentation as well, the transferor was looking at having a nominee director appointed immediately upon closing, at least until the time the listing process happens. And therefore, there were concerns and questions around liability of a director because as we all know, there are civil and criminal liabilities associated with misstatement or in prospectus, and that goes into knowledge of the director, that goes into whether the director consented to the disclosure, whether there was any connivance, whether it exercised appropriate due diligence, and therefore so all those issues were analyzed except in our situation because this was a director being appointed literally while the IPO process was on and was a nominee director not involved in day-to-day operations of the company. There was appropriate defense, and then we also suggested a DNO insurance. I hope that answered the question.
Sure. Thanks so much for that, Tanvi. Before closing, I would like to ask each of you to please respond to the poll slide. Mitesh, if I can please request you to put that up on the screen, please. Yeah, we take this very seriously as part of our continuous improvement program. So I'd request the members of the audience to please respond to this poll. Thanks to everyone who's participated in the poll. Finally, I would like to thank all of our presenters today for sharing their expertise and experience with us. You were simply outstanding, if I may say so myself. Thank you so much. Also, thanks to you, our audience, for your attention and your questions. I hope you found the webinar interesting and a worthwhile investment of your time. We thoroughly enjoyed bringing it to you. After the webinar, we will send to you a copy of today's presentation materials, summary notes, and a link to the webinar recording. You will separately also receive a request for your feedback on the webinar. Please take the time to send us your feedback, comments, criticism, and even compliments. The form should take less than 1 minute of your time to complete. If you are interested in in-house training or any other matters arising from this webinar, please do not hesitate to contact us. Our contact information is on the contact slide, which is on your screen now. Thank you for your attendance today, and we look forward to being with you again at the M&A Masters.
Thank you.
Thank you all.